think it's best not to just blindly just buy because it's down. I think it's better to understand.
What's your frame on this? Ideally, you're finding stuff that you can hold for 10 years or longer that are great businesses that we can just sit back and let great managers and the great business models carry the compounding for us.
All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer some questions. So I went to the Reddit machine and I found some really cool questions, and we got another great question from a listener. So we'll go ahead and answer those questions for everybody today. So buckle in and have some fun. So here we go. We got the first one. So I'm very new to the stock market. I have no idea what to do or how to do it, and I'm just dipping my toes for now. I was wondering about something. Intel stock has dropped significantly in the past year. A stock used to cost $51.28, now only costs $18 as far as I know. Of course, things aren't looking good for Intel, but wouldn't it be the best time to buy as much as I can of their stock? Intel is a big company, and surely they will rise back up again, right? No? I honestly have no idea, and I would love your opinion on the matter. So, great question, and kind of appropriate with the market being all schizophrenic at the moment. So I think, what are your thoughts on this question, and how would you help guide them?
I would first start by saying, look, you are in the game, and being in the game is the most important part. Investing is all about taking your hard-earned money and putting it to work for you. So whether this decision you make on Intel or some other company works out in your favor or not, the most important thing is to not quit, because that's what you need for the compounding to happen, is for you to be putting money out there and allowing it to grow over a long time period. You're not going to hit all winners. Trust me, nobody does, but you do it enough and you will get enough winners that more than pay for your losers. And that's how you build significant wealth in the stock market. As it comes to Intel, oh boy, there are, I don't want to beat up on this person, but there are some, I think, common misconceptions, myths, or I guess you would call it common sayings that people in the market mention that to me are just completely wrong. One of those being, oh, this is a big company, so they're going to do fine. That I very much disagree with that. And that's like the first place I would start, because I'm automatically staring at that and I'm like, no, don't look at the stock market that way. So when you're looking at what kind of stock to buy, what you want to invest in for the long term, it is true that usually the biggest company in an industry is the one that's going to be the better one, especially because of something called economies of scale. So the bigger you are, the more you can spread your costs and the more advantages you get. And so you do get a lot of the leaders or the top dogs of an industry who remain that way and even strengthen their position from their size. But, and especially in technology where things move so fast, Intel is actually a poster child of what can happen when you're big, fat, and happy in the technology space. And what can happen is disruption. Clayton Christensen is a professor at Harvard Business School. He wrote a great book about this called The Innovator's Dilemma, where, and I love for Dave to explain this because I think he has thought about it more deeply than I have lately. But basically, an incumbent, a big company who is the leader, gets taken over by a small company because the small company is more innovative. And there's several other factors that kind of play into that and kind of feed into that. But that would be my first point, is like, look, just because it's big and just because you know it doesn't mean it's a great investment.
Yeah, that is 100% true. I think the description of Intel becoming fat and happy is probably a really, really good place to start with, because if you look back on the history of Intel, if you read the book Chip Wars, if you're curious about the semiconductor space, you need to read the book Chip Wars. Not necessarily that it's going to help you pick out the best one today, but it'll certainly give you a framework and a groundwork to understand what's going on today. And Intel was the NVIDIA of its day. It was leading edge. It was cutting edge. They were on the forefront of everything. And through a basically change in management and a series of poor managers. This is Intel will be someday a great case study for what can happen to a company that's on the forefront and suddenly gets behind. And basically, Intel lost its edge. I mean, it's the easiest way to say it is they lost their edge, and now they're scrambling to try to catch up. And as Andrew has taught me in the semiconductor space in particular, it's not just a matter of throwing a whole bunch of money at something so that you can become the leader again. You have to advance in the technologies. You have to do the work to understand the technology to become back at the leading edge, and you can't just skip forward, so to speak. You have to go through the steps. You have to learn this to learn that to learn that to learn that, and you can only do that through a process. And so you can't just go, okay, I want to go from here to D. You have to go through B and C to get to D. And Intel is trying to do that now, but now they're trying to do it quickly to get to D, which is already where NVIDIA and Micron and AMD and everybody else is already playing and beyond, and Intel is behind. So anyway, all that to say, the innovator's dilemma certainly strikes hard and deep and swift with Intel. And really what it boils down to is the innovator's dilemma. Andrew described it really well. It's an incumbent gets kind of fat and happy, and they start to lose their edge. And then other companies, younger, smaller companies, come along and they find a niche product. In this case, NVIDIA with GPUs. It's a different way of computing. And because they were so small and because it was very niche, it was really hitting in the gaming industry for a long time. That was not something Intel was interested in and never thought it would ever really be anything. And we have learned since that, yeah, it became something, and it's taking over everything. And so that's what happens in the innovator's dilemma is a company comes along in a small niche, the big fat and happy ones kind of ignore it until it's too late. And that's really what's happening now with Intel. And the idea of, a big company will always bounce back. Yes, there have been some examples recently, things like Meta, for example, that was really down and out and has bounced back. It wasn't business related. That was more stock price related and the perception of the company related, as opposed to Meta not doing its thing. So that's kind of a different case. But Microsoft was definitely on the down and outs before Satya Nadella took over and kind of shifted the company and where they're going and how they're going. So that's a good example. But unfortunately, the history of the stock market is littered with dozens and dozens, hundreds of companies that were unable to shift and were overtaken by other better competitors. And that's the nature of the beast. And it doesn't matter how big they are. Sears at one time was a massive company. Companies like GE were massive companies, and now they're just shelves of themselves. So history has shown that just because it's a big company doesn't mean it's going to last forever. And they all go through life cycles and whatnot. So just buying it just because it's big is probably a mistake. I would encourage anybody that's listening to this that's considering those kinds of investments to do your due diligence and understand what the business is and what the competitive landscape is for them, and then make a decision, not just because, hey, it's a blue chip and hey, it's really big and it's going to come back. It's not always the case. Most of the time, it's not the case.
If you are to see that it's big, and we've already established that shouldn't necessarily be your yes or no, what is the next consideration in your mind about this as a potential investment?
I think for me, it goes back to I really need to understand the business. I got to know what they're doing, where they're going, and how that stacks up with their competitors, because that's really what it all comes down to. And if they aren't producing a product that people like and want to buy, then it doesn't matter how big they are. It's not going to be, I mean, it may have some success, but it's not going to have an outsized success. And so it really comes down to what they're doing, where they're going, how they plan to get there, and how that stacks up against the competition. And if they don't have that, to me, it becomes a too hard pile.
Yeah. And it also depends what's your frame on this. For me, for Dave, I'll speak for him because I know him pretty well. we are on the frame of 10-year. We want to hold stuff. Obviously, we don't hold everything for 10 years, but ideally you're finding stuff that you can hold for 10 years or longer that are great businesses that we can just sit back and let great managers and the great business models carry the compounding for us. So we don't have to find a new stock every single month, kind of an idea. With Intel, it's hard because not only does that industry change so fast, but the nature of what they do. You mentioned what kind of customers they have. What we have seen in the industry is the demand for CPU computing has not been as strong as it was. Big part, like Dave was saying, of the GPUs now. All the data centers being GPU driven, a lot of compute being taken from a physical computer and sent to the cloud. So that has a big impact on Intel. So even if they have the best CPU, if people aren't buying as many CPUs, their IT spend isn't as high of a percentage as it was 2-3 decades ago. That's going to be a problem. And unless that changes, it's hard to see Intel, barring a successful pivot into another business model like they're trying to do with the foundries. But barring something like that, it's going to be very tough for them to get, if you're trying to beat the market and just hold a stock for 10 plus years, it's going to be hard to achieve that if they don't have these new demand drivers or a new business model with high growth. Now, certainly you can look at the price and maybe it's come down. And maybe you could say, yeah, in the next 6 months or a year, it's going to rebound and rocket up. I'll be in and I'll be out. Fine by me. Like if you want to play that game, that's totally on you. We're not really talking about that for the kinds of companies that we buy and the lens that we're using. So those are the types of things that I would look for. But I mean, you can be successful sometimes buying stuff cheap that's hated and then getting out when it's not as hated. Because to your point, I mean, if they still have products that are decently profitable, maybe they're not taking over the world, but maybe they're still bringing in billions of dollars. There's some value there. People are going to buy for a dividend, or they're going to buy for buybacks, or just, you just won't see very many businesses that can survive that will trade for such a low multiple that, like as an example, if a company has 10 billion in cash and the stock's at $10 billion, not many people, because there's so many eyes on Wall Street these days, not many people are going to ignore that unless the company's literally about to go bankrupt. So there will always be that floor for so many different companies, and money can be made. But if you're looking for something over the long term, you do have to consider the business, and the facts of the industry make that really hard. Yeah. So we've kind of piled on this question. What would be the silver lining here, or what would be the next tangible step? Because looking at a big company and seeing a stock that's down, I think is a great potential opportunity. It's a great way to look at things for sure. It's a great place to turn over rocks and maybe find a good investment. So if you had to give this hypothetical person a pat on the back and a direction forward, what would you say?
I would say that looking for contrarian ideas is a really good place to try to mine for potential ideas. And I think it's a great idea to look at companies that you may know well and may have an understanding about what the business does and whatnot. And if it is unloved or unloved comparatively, then that could offer you a good opportunity to get into the company. And so I definitely like the way that they're trying to think and trying to look. And I think it just comes down to, you have to take it case by case. Some companies, in this case, Intel is unloved probably for a good reason, whereas maybe some other ones that could be more on the unloved side may not be as logical. There may be maybe not systematic reasons why they're unloved. It could be that investor sentiment toward that sector has turned, or maybe there's been some bad news recently that is kind of more of a nothing burger. So there's definitely those circumstances. So I like the way that they're going, and I think, kind of use a basketball term, keep dribbling with your head up and looking for opportunities. But you have to take it case by case and don't assign a kind of a blind obedience to, okay, it's big, it's cheap, it'll bounce back again. I think we've kind of explored that you need to think about the idea that it is and make sure that it is a legitimate idea, that it still has good prospects going forward. As Buffett would say, you can analyze it and see that it has good prospects. And if it doesn't, then okay, that's too hard pile, move on to something else, because there's 1,000,001 companies that you could choose from. And so I guess that's kind of what I would suggest to them.
Yeah, that's good advice.
Okay. All right. So let's move on to our next question here. So the question is, how can management decisions such as capital allocation and mergers and acquisitions affect shareholder value? Fantastic question. And what are your thoughts on this?
It can certainly change the values a lot. And more so, even it can do a lot of bad, and you'll see the bad will be really bad. And of course, some managers can do good too, but usually the very bad cases outweigh the very good cases. Always exceptions to the rule, but in general, you will see some very bad ones, and that's just kind of the case. What are your thoughts on this?
Well, to me, capital allocation is job number one. And for every CEO, their job is to allocate the money that the business makes to try to make the business grow. And the better they do that, ideally, the better the business will grow. And the hard part about this is that sometimes it's hard to measure. And the other part about it that can be challenging is that many CEOs that get into the positions either have no experience in that particular industry, or they come from, let's say, operations, or they come from marketing and really have no experience allocating capital. And so maybe they have to offlay that to maybe the CFO, for example, because that's maybe not their area of expertise. And so it just, some of those things can lead to problems for the company if they're not done correctly. And a lot of times when you see businesses that maybe are struggling to grow, it's because they've put money in bad places. Acquisition seems to be the one where they can get the most trouble, because sometimes I like this phrase, they're trying to empire build, and as opposed to necessarily build the business. And really what I'm saying is it becomes more about the ego of the CEO as opposed to creating shareholder value. And a lot of times they overspend to satisfy that ego, and then it doesn't turn out well. And when it doesn't turn out well, really the shareholders are the ones who suffer. And so this is where it can really cause a lot of damage to us as shareholders. And this is one of the things that really has set Buffett apart from the pack, is that he's done a really fantastic job of acquiring businesses, putting them under their umbrella and allowing them to succeed. Mark Leonard has also done an amazing job of doing that. That's generally the way they grow, is by making acquisitions, and they make hundreds of them a year. And so that's certainly a skill that he has that not every company has. So it's definitely something to be aware of.
Yep.
So do you have any examples you wanted to maybe share of somebody that's maybe not done a good job of that?
Well, I think one of the classic ones is the whole, was it AT&T buying Time Warner? And it was something where they paid 220 billion plus, and ended up, oops, it was only worth like 10 or 20 billion. That was a lot of money they lit on fire. And hooray for the shareholders who got bought out. But if you look at the stock price for AT&T after that, it was not pretty. And that's what happens, is you basically have, what happens in effect is a company makes profits, and shareholders, all the stock market all assumes that those profits are going to continue to grow because they have been growing. And then you make this huge mistake in capital allocation. And now what was supposed to lead to growth is now no longer leading to growth. And now you have money that, instead of being reinvested in the business, maybe is paying off debt on something that was a complete waste of money. And I think that's pretty common. But you don't hear a lot of bad capital allocation can sometimes fly under the radar, especially because you won't necessarily see the negative effects right away. And Wall Street has this weird thing that they do where they don't look unfavorably on impairments.
Right.
Almost like everything's always priced in. Like, oh, we already saw that your growth had stagnated. So, I mean, I guess it makes sense, but still, you generally don't want to be in a situation where the capital allocation has not been ideal.
Mm-hmm.
Another form of bad capital allocation would be buybacks when a stock's valuation is super, super high,
Mm-hmm.
because the return you get on those are very small. Buybacks ideally will reduce the pie, making your slice of the pie bigger as a shareholder, as part owner of a business. But if a company is taking its profits and buying back its stock at 150 PE, they're not getting very many shares for the profits that they're making. And so your slice of the pie is you're lucky if it's growing at all at that point. Maybe it's just offsetting dilution. So that can be another way where it's like, cool, this business is making all this money, maybe, and none of it's going back. No, none of it's benefiting a shareholder in a tangible way, because it's just being thrown at this expensive stock price. And that has happened a lot. I think you're starting to see some of the effects of that when there's market turmoil. But I mean, color me surprised, because these kind of stories seem to happen all the time and nobody seems to bat an eye. And, we're all no wiser for it because people continue piling into these stories. But
Right.
It is what it is. That's just something that, to me, I would avoid those kinds of situations, because you can lose a lot of money that way.
Yes. Yeah, for sure. For sure you can. And it seems like it's become a source of pride to announce that you're buying back shares, and they just do it because they think that shareholders expect them to, regardless of whether it's a good choice for the capital allocation or not. And that's where it becomes, okay, was it really a good choice? As to your point, it's trading at 122 PE. Is that really the best? Is that the best place you could put the money? Seriously? Like, you have no other investment ideas you could put it into if it's that expensive and it's probably doing well. Like, you could probably reinvest something in the business that's doing better. And it definitely, I mean, these all have impacts on us. So like Andrew was saying about the slice of the pie, I think that's a great illustration. And if they're choosing poorly, then, I'm getting a smaller bite of the pumpkin pie, and that's never going to make me happy. So that's the way I look at it. And again, it's job number one. This is the most important thing that they do. And so finding good capital allocators is it's an art. And once you do find one, it's definitely something you want to hang on to.
Any examples burn in your brain about, like, this was a really bad capital allocation story?
Probably two that spring to mind. Number one is the whole AOL Yahoo thing. That was a dumpster fire in the offing, and it basically destroyed both businesses. So it wasn't just killing Yahoo, it also kind of killed AOL too. And that was a gross misuse of capital. And I think a couple other ones that have sprung to mind would be in the payments industry, Fidelity National and Global Payments Network, GPN. They both bought payment processors. And this was at the same time that Fiserv bought a payment processor. So all three big payment companies invested heavily in these companies, and they all spent roughly around the same amount, 35 to 45 billion on these acquisitions. And the first two have already spun those off or putting them up for sale and have impaired their income statements billions because they were terrible acquisitions. They did a horrible job of integrating them and really crushed the stock price for both businesses. And of course, they'll probably recover to a certain extent, but they've really set the businesses back and the shareholders back a long, long ways, just because all three of them wanted to go down the payments playground, and only Fiserv was able to do a good job of integrating their acquisition, and the other two didn't, and they chose poorly, and it impacted companies mightily, and it still is.
That's a great example. And I think it's more common than somebody should write a book about it, maybe. And maybe somebody has, but
Right.
just this idea that companies will literally copy what they see their peers doing without even putting thought into whether this is a good decision or not. Well, they're jumping off a cliff, so we'll do it too.
Right.
And that's usually not a good recipe if it's in a business that's not a good ROI business. And so that's a great example of that.
Yeah. Yeah.
The best stock picks require a light bulb moment. To see exactly what that looks like, check out one of my previous reports at stockwriteup.com.
So for our final question for today, so this is Dave and Andrew. I've been listening to your podcast for a few years now, and I cannot thank you enough for the work that you do. I have been a subscriber to Value Spotlight, and I love it. Every month, I put in a set amount for the recommendations you make. I have some extra money, and I want to invest that into some of the companies that you've recommended in the past. I noticed two opportunities that piqued my interest. I want to put the extra cash into the Texas Instruments as well as the Crown Castle. My question is, if you had to choose one, which would you pick? Both are at lower prices. Do you still have the same conviction for Texas Instruments or for Crown Castle, and which do you think would be the smarter play? Either way, I would love to get your insights on this potential idea. Keep up the great work. So this is from Boz, and a great question, and this is directed at you, Sir Andrew.
Well, thanks for writing in, Boz. We really appreciate you listening and taking the time to ask us this, because this is kind of fun.
Mm-hmm.
Maybe not so fun for me because both of these stocks have been among the worst decisions I've made in the past couple of years, and both for different reasons. I think the Crown Castle one in particular is interesting right now because what we have seen is an impairment, and that was reflective of the CEO who's now gone, but basically taking a bunch of money and putting it in this strategy, this fiber strategy, small cells strategy, that has now been determined that that's not going to produce the type of ROI, the type of growth that the company would hope for. And so you haven't really seen the stock be affected all that much, but Wall Street has seemed to know this story for a while. And there were some activists who came in and stirred things up in relation to everything that is happening. So we are getting an example in real time of when poor capital allocation can happen. And unfortunately, I've had to ride through that. And at the time, I thought it was good capital allocation. I thought it made sense. I thought the 5G thing with self-driving vehicles and all of the data that is needed for those things with robotics, I really thought small cells would be the next area for growth for Crown Castle, and it has not been. Luckily, I buy things with a margin of safety, so while it has underperformed, we are still getting 6%, 6.5% on the dividend. So that's been nice. The question of whether to add to a position like that, I think really boils down to what is your opportunity set at the time, and how does the company you're looking at compare to that. Obviously, we won't get this right every single time, but you do want to try to think deeply. Unfortunately, I haven't found that it's as simple as buy all the stocks that are down in your portfolio and you will do great, because Crown Castle was actually a buy the dip situation. It was a good buy the dip, but it still hasn't made the stock take off like I originally thought. So to me, again, it comes down to the opportunity set. What do you have in front of you? Do you like the outlook of those stocks or of the stock you're thinking of buying the dip for? And then the flip side of that, one of the arguments is, well, if you wouldn't buy a stock, why hold it? Why don't you just sell it? I think that's a dangerous way to look at things, because then you can second guess yourself with every stock you buy for now to the end of history. Because if I'm looking at Crown Castle, I'm not adding to them at this time. That doesn't necessarily mean that I'm going to sell them either. You just have levels of conviction. You have levels of optimism, levels of opportunity. And so we're constantly juggling those. I think it's always good to ask yourself, is this a time and place to buy in and buy the dip? As it stands right now, though, we've been talking about semiconductors. I have dipped my toes in a couple of semiconductors in the last few months. And I liked the opportunity set and the future potential of those semiconductor companies more than a company like Crown Castle. And I just think the ceiling there is higher. And so with my longer time frame, that appeals more to me. And because Crown Castle does not have that small cell growth outlook moving forward, their upside's not as high as I previously thought. So not a case to sell, but also not a case to add. So that kind of thought process, I hope, is helpful in debugging a situation. Maybe you're holding the stock and maybe it does dip and you're wondering, do I buy this dip? Try to think of it from a business perspective. Try to think about where you see the next 10 years and think about upside and downside. I always like to think in upside and downside when it comes to buying something, because I think that helps. That certainly helps simplify things and sometimes make those decisions a little bit easier.
Mm-hmm. Yeah, that's a good explanation. So I guess, what are your thoughts on Texas Instruments then?
Texas Instruments is a hard one. I mean, I know you're bullish on it, Dave. We both have it. I know Leandro's bullish on them, but they have been struggling. So profitability for Texas Instruments has really come down. The revenue growth isn't comparable to peers. They've really been pulling back that business, and there's competition from China, which is making it hard, but they're really sort of consolidating and reinvesting in growth in a way by having these new, bigger factories. So it's a tough situation. I have had stocks where I've bought the dip. I don't do it very often, but it has happened. And you ask yourself at that time, like I bought Pulte Group years ago when everybody was freaking out about residential real estate. I still thought the business looked great and I thought things were intact. So I purchased it. When you buy the dip in a stock, you don't always need to have numbers that just rebound miraculously. A stock can sell off even if the numbers look great. And so to me, that can be a great time to buy the dip when the numbers still look pretty good, but the stock's getting hammered because people are just being emotional about the company. Apple is actually a great example of this. Apple, and our buddy Andy used to always say, like, always buy the dip in Apple.
Right.
And people will repeat the phrase that Apple doesn't innovate. And then they come out with the iPhone 6 and then they come out with the iPhone 13. So those are the types of situations where earnings can be going up and up and up, and earnings per share up and up and up. And people just get this idea about the companies. Some analyst says something and, some macro thing happens and Wall Street's really down on the stock. But if the numbers still look good and the moat has still not been really damaged, that can be a really great opportunity to buy the dip. So it's not always easy. It's a great question. I've been looking at those stocks for a while and it's very tempting. For Texas Instruments, I'm waiting for those numbers to look better. For Crown Castle, similar story. I'm waiting for those numbers to look better. And we'll just have to wait and see. And, I bought these companies for a reason. So I'm not selling them. I still believe in the strength of their business models, but the opportunities that I see compared to those where the numbers aren't great, that kind of frames my mindset on it.
I think that's a great way to think about them. I mean, you have to take it case by case and you have to look at I love the idea of looking at the opportunity cost and the opportunity set of these particular ideas versus other things you may own or other things that are out there, and understanding where each of them is in their own business. Crown Castle is at a different place than Texas Instruments is. And so you just have to, I think that's the best way to do it, is just to weigh the opportunities and decide. I think it's best not to just blindly just buy because it's down. I think it's better to understand what it is you're buying and why you're buying it and why it's down. It's not unusual for companies to go through drawdowns. It's a normal part of the stock market, but you need to understand why it is and not just blindly buy it just because you really like it and it's down. A lot of times there's an actual reason why it's down, and you need to understand that before you pull the trigger and buy something just cause.
Yeah, and unfortunately for both of these, there has been things that have happened, and yeah, the numbers have not looked as great as they used to.
Right. Yeah, it makes it hard, right? It's what makes the game hard.
It does make it hard, yes.
But that's why we pay you the big bucks to make all the decisions for us.
Well, yeah, I am looking at these every single month. I'm looking at the whole portfolio. I'm looking and trying to balance between opportunities. And if you're there and you're taking advantage, then that's great because we're all making money together.
Right. Exactly. All right. Well, with that, we will go ahead and wrap up our conversation for today. I hope you enjoyed our question answering. And again, if you have a question, please send it to us at newsletter@einvestingforbeginners.com. You can also send us questions on Spotify. You can ask them on the app, or you can reach out to us on the X Machine. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.